Hi, this is Carol Mazzola with Keller Realty. I'm here today with John Marinaro from Advisors Mortgage Company. I've known John for many years. I've worked with him and trust him implicitly. So John, thanks for joining us today.
Thanks for having me today, Carol.
I have a couple of questions.
Sure.
I've been approached by many of my buyers who've been asking me about FHA mortgages, conventional mortgages. They're very unclear because there are so many products out there. So can you start with question one? Just break down an FHA mortgage for me.
Sure. So typically an FHA loan in comparison to a conventional loan is going to be more flexible with credit, debt-to-income ratio, and your down payment. With an FHA loan, you could get a mortgage with as little as a 580 credit score. Typically, we would like to see you over 620, but again, a 580 is workable. With as little as 3.5% down on a 30-year fixed rate, you can qualify for a mortgage, and you don't need any reserves. You just need enough to cover your down payment. And again, it's going to be a little bit more flexible than your traditional conventional mortgage. It helps many people secure a property where they ordinarily would not be able to, since they don't maybe qualify for a conventional loan.
That's great. So what about conventional loans? I know that a lot of my buyers were under the impression that you needed 20% down. And I know that you have told me that they can purchase for a lot less down, so could you explain that?
Sure. So it's a big misconception and a myth out there. A lot of first-time home buyers think they have to save up 20% for a conventional loan. There are avenues where you can put less than 20% down. That will cover, it will have private mortgage insurance. PMI is the word that the letters that everybody uses out there to basically PMI is a third-party company that will insure the mortgage in case of a foreclosure. The bank will only cover up to the first 80% of what is being financed. Within the PMI world, there are different options that you can have. As far as you can have a monthly payment with the insurance. You can have what's called a lender-paid mortgage insurance. You can have an insurance where you pay for the premium upfront in 1 year. And then some companies like our company offer what's called financed mortgage insurance, where you can take the cost of the insurance and finance it right into your loan. So with as little as 3% down on a conventional loan, you can secure a mortgage also with a conventional loan. Just having that knowledge for a buyer will open up to them a lot more possibilities when trying to find a home for themselves.
That's great. Now, a lot of people are coming out of bankruptcies and foreclosures. I understand that there are programs available to them to enable them not to wait the 7 or 8 years that they were required before. They can purchase a home now. So can you give me just a little guideline on what
Correct.
people could expect?
So when coming out of a bankruptcy, depending on the type of bankruptcy you've had, there will be a waiting period, whether you're trying to secure a conventional loan, an FHA loan. Typically, for example, if you took a Chapter 13 and you wanted to get a conventional loan, you would have to most likely wait 4 years from the date of the dismissal or 2 years from the discharge date. So that'll be in collecting of the bankruptcy paperwork, going through that with the borrower and trying to figure out where they fit as far as the requirements go. On a Chapter 7, it would be 4 years from the discharge date. All right, so again, it's about having the customer pull out their documents, looking at the discharge paperwork. On an FHA loan will be a little bit more flexible, as we talked about. FHA would have a 2-year waiting period on a Chapter 7, and on a Chapter 13, it is a 1 year must elapse from the time that they made the bankruptcy. So again, there will be a couple different directions that will open up to possibilities of securing a mortgage, even though they've had a previous bankruptcy.
And what about a short sale?
Short sales have come up recently with the waiting period for them. Typically on a short sale, it would be 4 years from the time on a conventional loan, and that's from the date that the property sold. It's not from the day that the person walks out the door. It's the day that the property has sold 4 years. You can do a 2-year waiting period also with that, but there are some exceptions that we'll have to evaluate depending on the borrower's circumstances. And on an FHA, it is typically 3 years.
And what about short sales? Is there a different time frame between that and a foreclosure or
Okay.
a bankruptcy?
So on depending on the type of loan you're trying to secure, if you've had a previous short sale, it would be 4 years on a conventional loan from the date that the short sale occurred. The key date on that is the day that the property transferred ownership, not the day that you walked out of your home, but it's the day that the property sold. You can apply for an exception after 2 years. That would have to be evaluated based on the borrower's circumstances. On an FHA loan, it's a little bit more flexible. You would have to be 3 years after it has been occurred. Foreclosure is going to be a little bit different. It is going to be a 7 years waiting period on a foreclosure on a conventional loan. Again, there is a 3-year exception period, so there are some flexibility with that, again, depending on the borrower's situation. And then on an FHA, it's 3 years from the completion date. And again, it's always the key dates are the date that the property transferred ownership on foreclosures and short sales.
John, thank you so much. We're running out of time.
Thank you for having me.
You're always so helpful. You
Thanks.
always have every answer at your fingertips. So I hope you'll join me again, and maybe we can go into other situations that people ask me about.
My pleasure. Thanks for having me.
Okay. This is Carol Mazzola with John Marinaro of Advisors Mortgage. Thanks for watching.